Welcome back, my passive income investors. I like to a deep dive review of my $314,000 dividend stock portfolio. As we do here, I'm going to be touching base on news that I feel is most prevalent, and then we're going to talk about stocks that I'm interested in and actually deep dive down into the portfolio itself. So as I document my financial independence to perhaps one day retire early, consider smashing that like button, folks, and let's kick this off as we do here by first just talking about Wealth Simple, because something really big happened to Canadian investors. We finally have a platform that offers commission-free and on top of that fractional share buying now, guys. In counterpart, only in the US you have things like M1 Finance that allow this, and I partially believe it's because Canada's population is far too small to bring on enough clients to justify doing something like that. However, it's not all clean, cut, and dry because they still don't offer US accounts from my understanding, and they charge a 1.5% fee on buying US securities. So even though you're not paying anything anywhere else, every time you buy and sell a US stock, you're technically paying 3%, 1.5% on the buy and 1.5% on the sell. So just be careful. But honestly, if you are new to investing, this is where I would probably be starting, because recently in the middle of a tornado storm, if you guys are local to the area, I'm sure you've seen Barrie getting destroyed. I was recently just talking about how I might be interested in buying real estate there, but maybe not in this very moment. However, I was on the phone in the middle of a conversation with a PayPal employee because I found a really annoying flaw with PayPal that they're kind of loopholing to make a lot of money. And this really pissed me off, and it's going to make me change the way I format my use of PayPal. And basically what's going on here is, being a Canadian, I do a lot of work in the US, and it's way easier for people to pay me USD through PayPal. However, I want to keep that USD in USD, and I want to transfer it into my bank account so I can actually withdraw it as USDs if I wanted to. I found out that PayPal, even though they'll let you link a US account, you can see the US account, it does show up on your PayPal when you're linking your banks, it just keeps erroring out, and I couldn't figure out why. So I had a conversation with them, and they told me, hey, we don't allow you to withdraw USD into a US bank account being a Canadian. You can use that USD, you can buy stuff with it, you can transfer it to people, but if you want to pull it out, we're going to make you convert it to Canadian first, which I don't know why, because if I do a wire transfer, I'm not forced to do a conversion. And then I found out PayPal is making 4.5% on the conversion fee. You know how crazy this is? So every time I convert 10,000 US dollars, I'm paying $450. That's more than like annual dividends on an investment, right? Like that's an absurd amount of money. So the guy on the phone was really polite, but I'm starting to hate PayPal, and I think I'm going to start shifting to wire transfers. Incrementally, you wouldn't think it would matter, but once you get to the scale of my business where you're generating six figures and half of that is coming in USD, PayPal is becoming one of the top largest companies in the world because of this right here. They are the most expensive converting platform I've ever seen. But putting my frustrations with them aside in the midst of a hurricane, let's talk about the portfolio itself here, folks. I'll scroll up, take a look at the general overview right now, and we'll talk about some of the biggest changes, and then we'll get into some of my individual accounts to talk about stocks. But first, guys, things are pretty relatively all-time highs. Every week, over the week, markets just keep going up and up and up. We've seen a lot of expansion right now in tech. I've seen a lot of it in the REIT sector, with my stag hitting all-time highs today. It hit about $40 a share. RioCan back to its normal prices of around $23 a share, holding up pretty nicely. And I've been just sitting on my hands politely stacking cash, which we can see I've got about $24,000 in cash stacked. So just taking a look at the entire portfolio overview and the individual holdings, guys, I am going to be investing this cash, or a little bit of it, not a lot. I told you I want to keep my emergency fund around $20,000, which is roughly 6 to 7% of the entire portfolio. That is just as my portfolio ages, as I want to change my living circumstance. I just want to really make sure my portfolio is well-rounded. Now, there's more cash there than I initially wanted, but this is coming from dividends, a lot of other places that, like I said, I will be investing, which we'll take a look at in a second. Other than that, however, folks, across the board, things are just relatively sweet. I mean, RioCan, I wish it was below 10%. It keeps holding all-time highs here for me. So it makes up 11% of my entire portfolio, which I'm not exactly comfortable with, but to not get whipped with taxes, I'm going to hold off from scaling it down and taking any profit on it or capital gains going into 2022. So it's kind of where I sit, with 26% of my portfolio currently being about growth, 67% being dividends, which means 206,000 are in dividend stocks, 79,000 is in growth, but I classify Microsoft and Apple as kind of growth in there. So those are technically dividends as well. And on that note, Apple and Microsoft are huge positions in my portfolio again, just because I mean, Microsoft has been exploding here, guys. Apple has been pushing all-time highs, getting to $1.50 a share. So both of these positions almost make up combined about 20,000 each. Now, before we dive down into the particulars themselves, let's talk about if you enjoy the way I track my portfolio, you want to support the channel, as always, come on over to thechartmaster.com. Use coupon code Passive Income Investor, get 15% off. Buy one of our spreadsheets. You get all of them for free, except the crypto tracker that is sold separately, as it merges crypto and your stock portfolio into one beautiful spreadsheet. But that's what's going on there, guys. So let's talk about my largest account first, my TFSA. I'm getting a ton of money this month in this account. So what I'm going to be doing with it is continuing to add to my utility sector. I told you guys I really, really like Hydro One, pays a 3.5% yield, is a Canadian government spinoff that primarily focuses on transmission lines. This is a company that I pay a lot of money to. If you live anywhere in the general Toronto GTA area, you're likely to be paying this company money. And the reason I also like it is Ontario is exploding a lot. Not a lot of new homes going up, which is really going to drive a lot more income to Hydro One. So I'm going to be adding to that position overall. But other than that, this is going to be a relatively flat, boring account for me because that's just where I'm reinvesting the dividends for right now, guys. And just taking a look at the income in and of itself, we can see every one of my Canadian stocks has been paying out for July. I already got my RioCan payment, which was some of the cash we saw sitting in this account already. But every one of my Canadian stocks is going to be whipping out a fat stack of cash. So from an income perspective of my TFSA, that's about as exciting as this account is going to get for this month, guys. Taking a look at my RRSP, this is an account that I'm kind of frustrated with because this is a long-term investment account. You don't want to touch this until you're 65. And I'm kind of looking at this being like, why am I buying a lot of just dividend stocks in here when I should probably just be focusing on indexes? So I don't know if I'm going to do it this year. I'm kind of on the fence with it, but I'm thinking about keeping my foundational long-term growth dividend stocks like J&J and Pepsi. And I'm going to maybe sell Kimberly-Clark and Lockheed Martin. And I might just funnel all of that money along with maybe some more contributions at the beginning of the year into the Vanguard Total Stock Market Index Fund, VTI, or maybe even VOO. Because again, I'm not really going to be relying on those dividends for the next 35 years. And I think just buying a total market index fund would be best for an account where I'm not worried about chasing capital growth right away. I'm not really worried about chasing yield right away. And it's just going to be parked there for an extended period of time. It might be a better index fund account, and it would probably help round off my portfolio a lot better. Now, talking about the corporate account, this is where a lot of the action is going to be happening in the coming months here, guys, because this is where all my business money is flooding and all my business income money is flooding into this account specifically, where it's currently worth about $36,500. And Algonquin Power had a nice jump today. This is one that I'm going to continue to add to going into the coming month here, but I have one new position I might add, which I'll talk about in a second. But taking a look at the tech side of it, where I primarily want to hold a lot of my growth stocks, Tesla been holding flat. We're getting the new iteration drop soon of self-driving that's coming on the updates, which people are very excited for. I love what Tesla's doing. Really happy to hold that in the long term. Facebook is one stock I'd still continue to add to here. I'm not personally adding, but it's path of least resistance to wealth. I don't know why it's still trading down a bit. It's down to $340 a share. I would be picking it up pretty aggressively here in that Wealth Simple fractional share account if I were you, new to investing. And then Google. So the primary two positions I want to add to still is Google along with Algonquin Power. I'm going to continue to scale those up with one new position I've been very fascinated by. I'm on the fence with it because I'm curious to how telemedicine is going to affect this company, but we're talking about Medical Properties Trust. This is one of these REITs that's just been trading down ever since it hit some pretty good highs there coming out of the pandemic, but it's down 10%, pays a 5.5% yield, really reasonable PE, about a $12 billion REIT. And when you take a look at the numbers here, guys, I was blown away by how much revenue growth they experienced in 2020. So clearly, even though a lot of hospitals and walk-in clinics were relatively shut down for a portion of the pandemic, this company managed to absolutely excel into the insanity. Now, this is a company I've obviously mentioned, but 72% of the hospitals they own are general and acute care hospitals. So maybe if it's just like walk-in clinic sort of a thing, guys, and they're primarily located in the US, where that makes up the vast majority, 57% of the total portfolio. But I just love the diversity of this because I want more healthcare exposure. I'm just doing a little bit more due diligence before I make any major investments in it, because again, I've been looking through some of the books and there are some things that get a little fishy here, like the fact that they have have been just unloading an insane amount of shares onto the market to make acquisitions. And I just want to make sure that these acquisitions are adding a lot to the bottom line and it's not making up for losses that they might have experienced through problems with the pandemic. REITs can do really finicky things that can kind of hide the true numbers by like how well their income's doing, because just because in 2020 things did really, really well, did that actually come from the current business, the underlying fundamentals, or did it come from the fact that they're just doing more acquisitions? And are those new acquisitions really adding a lot of money to what they're already making, or is it cushioning some money they're losing somewhere else? I don't know. These are some of the concerns I always have when you look at companies that liquidate a lot of shares, because Stag Industrial does really similar things. And we can see that they're going to invest $950 million into behavioral health platforms. So they're going to be diversifying their portfolio a bit. And they also agreed to 5 general acute hospitals in South Florida. They are doing more acquiring of hospitals. But all in all, guys, other than that little bit of a concern, I trust that the company is actually insanely foundational. They've had incredible dividend increases, and I just feel like it would be a good income provider to my corporate account. And the fact that it's locked up in a corporation, I will be paying a lot less tax on the dividends. But bringing all of it together this week, folks, I want to pass the question off to you. What do you guys think about my portfolio against your portfolio? Is there anything you would do differently? How do you feel about Wealth Simple? And honestly, are you guys having the same problems with PayPal that I have, that they just won't let you pull that USD out in US currency being a Canadian, which is really frustrating. But nonetheless, stay cool, stay awesome, folks, and I look forward to catching you tomorrow.